The life of a macroeconomic investor can be pretty hard. There's a lot going on, and there are millions of moving parts. However, using data and research, you can get an idea of what exactly is going on in the world economy, or a specific country's economy. And recently I came across some data that shows how the economy is fundamentally changing due to the actions of politicians and big tech companies. So, let's look into it. Now, before the launch of ChatGPT, the economy was actually very different. Consumers were the ones who were driving the economy. Consumer spending was the most important thing. So as soon as the Federal Reserve lowered interest rates and started selling financial assets in 2022, a lot of people started to panic, because obviously this would affect the consumer, and that would affect the economy, and that could lead to a recession. But one thing they forgot was the fact that AI entered the arena. In 2022, ChatGPT and even what we're looking at right now, Sora, would eventually be released. And this would obviously affect the economy a lot. Because while the Federal Reserve was selling financial assets and increasing interest rates, which both get rid of liquidity, so there's less money in the economy, and also make borrowing money, because there's less money, more expensive, it was slowing down the economy. It was taking money out of the economy after the massive injection of cash after COVID. But one thing a lot of investors forgot about was the fact that a lot of big tech companies like Google, Amazon, and Meta had a lot of savings on the side and were now throwing that back into the economy, into AI, which was stimulating the economy and was most likely the reason that a recession never formed. The Federal Reserve was taking money out of the economy on one side, while the big tech companies were putting money into the economy on the other side. And to be honest, this effect is still in place. However, now the Federal Reserve is going to inject money of their own as well, because they have started increasing the balance sheet again and have lowered interest rates a lot. Recently, I came across some interesting data talking about the AI spending and how it's eating the US economy. And this chart that was created by Bloomberg and Renaissance Macro, which is an investment firm, clearly shows that personal consumption expenditure, which used to be an incredibly important part of the economy, an incredibly important thing for GDP growth, for the economy to grow, has become incredibly irrelevant, while information processing equipment plus software, basically AI spending, is a bigger share of GDP growth, of economic growth, than consumer spending on restaurants, clothing, phones, desks, whatever watching videos, whatever you think about. AI is a bigger part of the economy. I mean, a couple of months ago, there was even some data that came out about the quarterly results that around half of the growth that quarter was due to AI spending. Big tech taking out debt, which has become cheaper now, so they can take out more debt, and using their massive multi-trillion dollar, basically, cash reserves to inject it into the economy to build nuclear power plants, solar, data centers, employ people in order to build all the AI infrastructure. That's what's driving the economy. Now, when I originally saw this, I was quite surprised by it all. The fact that AI has become such a big driver that consumer spending doesn't even matter that much comparatively. And sadly enough, when I looked more into all of it, I could clearly see that the entire economy was driven by AI, while the normal consumer is actually kind of experiencing a bit of a recession. They're really struggling, and they have been for quite a while. According to research from Challenger, Gray and Christmas, which is another investment firm, the consumer hasn't been doing that well. You can clearly see from their data that layoffs have increased massively and are kind of at record levels. The last time we saw layoffs this high was around 2008 and 2009, during the great financial crises. And now, again, loads of people are being fired. We saw it trending upwards from around 2022 onward, and a massive jump from 2024 to 2025. Now, one thing you need to keep in mind with all of this is that a lot of those firings were also from the whole Elon Musk Doge project. So Elon Musk basically gutting the government and firing around 330,000 people. But still, job layoffs across the economy as a whole have been increasing. For example, in warehousing, in retail, in services, in media, in news. Surprisingly enough, that's not the case. And a lot of them are firing people due to overcapacity as well as artificial intelligence. So either AI is replacing them or they're getting rid of these employees because, again, it's not worth to keep them on. What usually happens in the economy when the Federal Reserve does something like this, inject a lot of cash, make debt very cheap, all of a sudden you get what's known as overinvestment and overcapacity. There's so much free money, cheap money, so much money in the economy that any business idea it can be funded because the borrowing costs are just so low, the risk is so low, consumers are flush with cash, they have so much cash, so even the dumbest things they don't even need, they'll just buy it. We'll buy a third TV, 6 fridges. It doesn't really matter. This is what usually happens in a boom and bust cycle, is a lot of either people are very excited about it or there's a lot of cash injection, usually a combination of both, which leads to overcapacity. So all of a sudden, everybody goes out for dinner every night because we have infinite money. And then when the money dries up and borrowing doesn't become as cheap, so we can't rack up those credit cards, people start going out for dinner less. So yes, all of a sudden it's not worth it to have 2 extra servers and an extra cook in the kitchen or the second restaurant in order to meet all this demand. The demand is dried up. And we're seeing a similar thing happening in the economy at the moment, the last couple of years. Basically since 2022 when the Federal Reserve said, all right, inflation is too high, we need to calm down. So we're seeing a lot of job cuts, also partially due to AI, because AI can replace some workers. And slowly but surely, they are replacing people. And with robotics on the rise, we could see even more jobs disappear. Now, this has affected consumers in an interesting way. And this chart gives us a good idea of what's going on. As you can see, this is from 1990 to 2025. We can see that the bottom 90%, so 60 to 90%, and the bottom 60%, basically the bottom 90%, 9 out of 10 people, have been dialing back spending. Like they're a smaller portion of the total consumer spending in the economy. Smaller and smaller and smaller and smaller. While the top 10% has become a bigger and bigger part of total spending. Around 50% of consumer spending is coming from the top 10%, while the other 90% is contributing around 50%. So the rich are incredibly important for the American economy. And it makes a lot of sense that the top 10% has become more and more important because we have seen a massive rise in asset prices, which is partially also due to the actions of the central bank, the government, etc. So both the S&P 500 has gone borderline parabolic, but also home prices have done incredibly well during this time period. From around 1990, when it was around $120,000 to $423 right now. So it makes a lot of sense that the top 10% is so important. But one thing we got to remember is that a massive share of the S&P 500, around a 35% of the S&P 500, is invested in the FAANG companies, the big tech companies, Google, Meta, Amazon, etc. While a lot of GDP growth is coming from AI spending and consumer spending has become less important, but even though it's less important, consumer spending is still a decent portion of GDP growth. However, a lot of that GDP growth is not coming from the bottom 90%, especially now that they're struggling in the labor market. And a lot of it is coming from the top 10% because stocks and housing have gone up so much. So the rich are flush with cash and their money is growing at a rapid pace, allowing them to also spend more, because the faster the money grows, the more they can spend without depreciating their assets too much, where they actively become poorer every year. We can see that the entire economy revolves around one thing: artificial intelligence. As soon as artificial intelligence slows down or doesn't deliver on the promise, the dream, the rich will most likely see their portfolios go down quite a lot because the market is also incredibly expensive. And in the meantime, the capital expenditure on AI will also die down, which is another big driver for economic growth at the moment. So yeah, the entire economy is being led and completely centers around artificial intelligence. We can even see that stuff like the Schiller PE is almost at record levels, like crazy levels. But for now, the music still continues to play. Because, like I just mentioned, the central bank is actually helping. Even though we're in kind of a bubble and a lot of economic growth is not driven by the overall economy, but just AI and the top 10% wealthiest Americans, the Federal Reserve is stepping in and stimulating the economy by either injecting cash. For example, here they're buying debt instruments, so forms of debt to make debt cheaper and that there's more liquidity in the debt. So a lot more can be borrowed and at a cheaper rate. They've also been lowering interest rates, which is another thing that drives the economy and allows it to go higher and higher and higher, because they've already cut interest rates by almost 2% at this point. So we're in a very interesting scenario. We're in a form of a bubble, and AI is like the sun, and everything is circling around, everything is spinning around it, and without the sun, we're all going to die. When will the sun die out, the AI dream? We don't really know. It could also be that AI does deliver in terms of automation and productivity growth, etc., and also in terms of large language models, and then this all might be justified. This expected growth might be justified because we actually achieve it. However, there's also a very decent chance that we will not achieve it and that we will have AI overcapacity, data centers that aren't really used, robots that won't really find a purpose in the economy. But when will it pop? When would that bubble pop? Well, we have no idea. And now that the central bank is stepping in to support it, and the last couple of years, both the Biden and Trump administration have also been passing legislation that also provide all kinds of subsidies and bonuses and cheap loans to AI and data center companies and other types of financial investments. I think this bubble can continue for 1, 2, maybe even 3 more years due to the amount of support it is getting. So it's a bit hard to predict when this will happen. I'm staying invested in the market over on my eToro account. As you can clearly see, I still have big holdings in cryptocurrency, healthcare companies, and also a number of big tech companies both in China and America, as well as the Netherlands. For example, CQQQ, which is tech, Adobe, which is tech, which still Adobe is the most undervalued company out there. It is crazy how people are not buying this stock. I recently bought more of it because it went down again and it remains ridiculously cheap. And they keep beating earnings. The company is growing at a very rapid pace, but for some reason everybody is ignoring it. ASML is another company I hold, which I have really big profits on, but I want to hold it for the long run, like a bit longer, because they are a key player in the whole AI revolution. They're the only ones that can create specific machines that are required for chip construction. Qualcomm also getting involved in the whole AI revolution. So I'm still exposed to it, but I do have some cash savings that I can deploy if all of a sudden the market drops. And obviously I have a number of hedges in place, for example the TMF, which will go much higher if interest rates are cut all of a sudden and the Federal Reserve needs to support the economy because there's a recession. But in general, I would say stay invested, but be sure to remain diversified, both in industries as well as countries. Don't put all your money into America, or if it's an American company, at least let it be a company that operates globally, not just America. And yeah, watch out when it comes to big tech and AI companies. Be a bit cautious when it comes to their valuations. If some of them expect massive growth, that might not happen. So be a bit conservative when it comes to that. Or if you want your investing to be a lot easier, you can also go over to eToro, create an account and copy my portfolio, and then I will manage it for you. And any updates will be posted here on eToro because I post 2 to 4 articles per week. Now, if you want to read the whole article I wrote about this subject matter, as well as links to sources, be sure to check out my eToro account. Links to it will be in the description down below. I hope you enjoyed this video. If you have any requests or ideas for things for me to cover or any questions, leave them in the comments down below and I will answer ASAP. And may the markets be with you.